Danny Tenengauzer of Bank of America Merrill Lynch Global Research joins us in the studio with his outlook. And Danny, of course, good morning. Thank you for coming in. Whenever you talk about emerging markets, we keep hearing about inflation. Inflation as this huge threat in places like China and other markets. How aggressive do you expect the emerging markets to be in keeping inflation in check, and how will that play out for investors?
Well, clearly it's a big concern right now because they are in between the rock and a hard place. If they hike interest rates too high, then flows will continue coming in and triggering even more currency appreciation and current account deficits. So clearly they are trying to find and strike a very fine balance between the two.
And some people have argued that China has been too reluctant, too conservative, and too cautious in raising rates.
That's right. They have been trying to use other instruments. So they're trying to cool down the real estate sector. They believe that the core of the story comes from the real estate sector. The problem is that real interest rates are negative. And we think that that's going to spread around the rest of the economy going forward.
We've seen places like Korea impose capital controls. Do you expect to see more creative uses of capital controls arise next year?
Everywhere. Everywhere. I can give you at least 15 examples only over the past 6 months. We're going to see more of that going forward. And again, that comes as a fine balance because they don't want to hike interest rates.
But will that do the trick in terms of stemming the foreign inflows?
No, we don't think so. We don't think so because, again, interest rates there are higher. We don't see rates rising either here or in Europe or in Japan. So as a result, that carry trade between G10 world and the emerging world will continue going in 2011.
So it's just a matter for the central banks to kind of moderate that inflow as opposed to stop it entirely?
That's exactly right.
Okay. Now, when we talk about the risks to your forecast, you have Europe, of course, with the sovereign debt crisis this year, and perhaps Spain, Portugal, some people are saying Belgium next year. The possibility of a double-dip recession in the U.S., although it's less an issue now than it was perhaps earlier in the year. Commodity prices continuing to rise, and the Fed perhaps pressing the brakes on policy. What's the most likely to happen out of all these risks?
By far, the sovereign debt crisis in Europe is the key concern. Clearly, there will be a level where CDS spreads widen out that would have a contagion impact on my markets. So we're clearly very much focusing on that front. We think that clearly the EMEA region, so the region around Europe, will be the first one to get hit.
Okay, so the Europe, Middle East, Africa markets.
That's true. That's true.
Okay, now within Asia, I'm taking a look at your top picks here. You like Malaysia, the Philippines, and Korea. Of these three markets, Malaysia and Korea have been raising interest rates. The Philippines has decided to keep rates at record lows. What's the common theme between these three markets?
Common theme number one is that their external imbalances are very benign. So clearly there are big exporters right now. Theme number two is that their currencies are cheap compared to everywhere else. Okay, and thing number
so there's room for that to increase.
Exactly. And there is demand for the bonds, and fixed income carry trades are really one of the things that we are watching going forward. And we believe that there will be demand for Korean bonds, local bonds, Malaysian bonds, local bonds, and the Philippines, the external debt.
When we talk about emerging markets, everyone's always warning, or at least the conventional wisdom is to warn on potential political unrest. What we've actually seen is more political unrest, you could argue, in places like the developed world with Europe and questions over whether the euro will survive. How big of a threat is political unrest right now in the emerging markets?
Well, growth and activity can clearly lubricate the politics, so that's very helpful in emerging markets. Having said all that, today Ivory Coast is supposed to pay a coupon on one of their bonds, and there is political unrest there, and there is a decent chance they might not make that payment. So you do have cases like that, but again, in the bulk, big emerging markets, we don't see any problems because activity is very strong.
Okay, let's talk about Europe, Middle East, and Africa. Poland is another market that you like, and of course, Poland has not adopted the euro yet, and that's worked out to be a very good decision.
It's I wouldn't say that it's a very good decision. It's a decision that turned out to be timely, wise, very, very smart. Again, countries that can print their own currencies to service their debt are better off going into a sovereign debt crisis.
Okay, very quickly here, what are your thoughts on Mexico and Brazil? Brazil being one of the BRIC countries. Yeah,
we're actually more favorable on Mexico than we are on Brazil because they're more investable friendly.
Okay, thank you so much for your outlook. We appreciate it. Danny Tenengauzer of Bank of America Merrill Lynch Global Research joining us with his outlook on emerging markets.